Good morning, Friday, August 22nd. Zach Howard, morning market update. And the theme for today is fade consensus narratives. All the time, especially in the mainstream. They are where the alpha is and will continue to be. People want clickbait, they want short-term narrative hits, whatever it can be. What are we looking at here? It's a chart of one of the best performing equity markets globally in 2025. Ironically, it's not the US stock market. It is the Chinese stock market, the Shanghai Composite, which just 3-4 months ago, every narrative out there said this thing was going down, 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 down. Trump, tariffs, yada, yada. When people not really understanding the Chinese has the biggest money printer of them all and has been shooting that bazooka for years. They have been doing GFC-like stimulus for the last couple of years. What does that mean? Real assets are going to go higher in Chinese yuan terms, and it's up. It's up and to the right. So fake consensus narratives in all markets when they become everybody on one side of the boat. On to Japan, probably the biggest macro issue out there if you're looking at Japanese bond yields continue to spike higher. Slowly, slowly, slowly. And all of a sudden now we're at a real level. It's the rate of change in markets, not the absolute, that breaks markets. Paper markets implode based on the rate of change. It's not that when it hits 1.75% on the Japanese 10-year, everything's over. But look where it's come. 0% interest rates to now 1.6 in 5 years. That's a massive rate of change. Looking at the longer duration Japanese 30-year government bond, even worse. This was closer to 1% back in 2018. Now up to 3.2%. Massive rate of change difference, but the longer the duration of that bond, the more receptive it is to changes in interest rates higher. The value of that bond comes down. The Bank of Japan has been supporting the Japanese government with this fiat monetary experiment for the last decade plus. They own about 45% of the 30-year Japanese government bond. If they were a real entity, if they were a hedge fund, an investment, pension fund, insurance company, etc., that had this type of exposure, they'd be looking at about a 23% reduction in the value of their bond holdings with that rate increase. So your AYZ hedge fund out of Japan, and you own $1 billion worth of 30-year Japanese government bonds, now at this level here, 3.2, the value of that bond portfolio is now only $770 million. That has implications then across your portfolio if you have hedge risk. On to the US, the volatility regime here the last week has spiked into this talking heads event. Once again, the Jackson Hole, Wyoming Central Bank parade. We're going to parade this old guy out. Jerome Powell is going to pawn on the world. Somehow he's going to make a difference in where global capital is going to go based on this old man's words. I don't think so. But market participants have heads into this event. 16 on the VIX based off this 0 days to expiry options after the day. Once this guy stops talking, all those hedges come off. 69% of flows into that 0 days to expiry option into this event yesterday in the options market from tier 1 alpha data. Looking down here, I talked about yesterday, the SPY and the QQQ's massive implied volatility premiums in those positions because everybody is hedged, thinking that the market needs to come down here because he's going to be hawkish, not dovish, yada, yada. It's all BS, guys. It's all BS. Zoom out. Look at the bigger picture. The U.S. economy is growing in the face of a devalued currency, like all economies globally. They are being devalued in their fiat. In real asset terms, everything needs to go up. The U.S. is at the perfect point here for stimulating growth. They have the rate of change where the central bank balance sheet, it's come down from $9 trillion down to $6.6 trillion or whatever this crazy big number is from where it shot up in 2020, more than doubled. Where is the rate of change going from here? Is it going to continue to fall or are we going to accelerate? We already know the U.S. government says we want to stimulate. The PMI is already saying we're there. They're going to do it in the backdrop of that. Run it hot. Inflationary pressures are the risk, not a slowdown in growth or disinflation. They will devalue the currency by any means necessary to continue to spur asset prices higher. Are we going to have pullbacks along the way? Absolutely. That's healthy. That's opportunity to take advantage of people that are over their skis in certain leverage trades. But you got to look at the backdrop of who's running the show here. A real estate developer who love leverage and love low rates, plus he likes to take down sanctions, take down in terms of his own government, take down red tape to actually spur capitalism, spur development in all areas, whether that's mining, oil and gas, etc. The surpassing of data center construction now past the office supply in the US, $40 billion here in 2025 in the data centers. That's just in the US. Capital is being redeployed for the new economy built around technology. Office towers will no longer be wanted. The debt associated with that asset will no longer be wanted. We are moving the goalposts. But the takeaways today is fade consensus narratives about markets can't go higher because of valuations and BS like that. And look what's actually happening. Look what the administration and the people that are in charge of trying to be central planners are saying about what they want to do with the markets. The markets need to continue to go higher. I would fade all the central bank BS today and be back and ready to go next week. Have a great weekend, and I'll see you next week.